Welcome to the Mayer Brown teleconference. I'll now turn the call over to Mr. Mike Hermsen. You may begin.
Thank you, operator. As she said, I'm Mike Hermsen. I'm a corporate and securities partner in the Chicago office at Mayer Brown, and I'd like to welcome everyone to our webinar titled Preparing for the 2016 Proxy Season. I am joined by three of my colleagues, Harry Boudry, Jen Carlson, and Laura Richmond. Harry is a highly experienced corporate and securities lawyer who's based in our Houston office. His practice includes the representation of clients in connection with public and private offerings of equity and debt securities, mergers and acquisitions, corporate reorganizations, and divestitures of businesses. He routinely advises and counsels clients with respect to SEC reporting, compliance with securities law and exchange rules, and corporate governance. Jen is a corporate and securities partner in Mayer Brown's Palo Alto office. Her practice focuses on capital markets, mergers and acquisitions, and general corporate matters. She also counsels companies regarding securities law compliance, stock exchange listing requirements, fiduciary duties, corporate governance, and other matters. Laura's wide-ranging corporate and securities practice has a strong focus on corporate governance issues and Securities and Exchange Commission reporting obligations, including the disclosure of matters relating to executive compensation, boards of directors, and Dodd-Frank and Sarbanes-Oxley compliance. Today, the things that we're going to be talking about are going to include the impact of Say on Pay and its evolving, how that's being worked through CD&A and other compensation disclosures and practices, the SEC's final pay ratio disclosure rule, the SEC's proposals for clawback listing standards, pay versus performance disclosure and hedging disclosure, proxy access and other shareholder proposals, director and officer questionnaires, as well as a couple of other annual meeting and annual reporting matters. During today's webinar, you will be provided with an alphanumeric code. Participants who are applying for CLE credit must record this code on the virtual sign-in sheet that was emailed with the connection details. Directions for returning this document are on that sheet. This code will be read in the middle of the presentation and then again at the end. Please note that in order for Mayer Brown to provide you with CLE accreditation, you must record this alphanumeric code and return it to Mayer Brown with the sign-in sheet. I will now turn the presentation over to Laura, who will get us started.
Thanks, Mike. I'm going to be discussing Say on Pay and its impact on compensation disclosure. And as you can see from this slide, for most companies, Say on Pay passes, often with really high majorities. But of course, that's no comfort if your company suffers a failed Say on Pay vote or just barely passes. When Say on Pay fails, or achieves a majority of less than 70%, the vote can impact director elections, and if compensation issues are not addressed, results the following year might be worse. All of this has given Say on Pay an outsized role for the proxy season, taking up a great deal of proxy statement real estate as well as management attention. Although Say on Pay is advisory, executive officers and directors generally recognize that failing the Say on Pay vote can have real consequences. As a result, shareholder engagement has increased on a year-round basis, especially on pay matters. To be effective, companies should think carefully about which company officer or perhaps compensation committee member is best suited to represent the company at investor meetings. It's important to prepare focus points for investor presentations. And it's also important to remember that if there's no corresponding proxy filings with the SEC, you can't be soliciting votes at these engagement sessions. Instead, ask what compensation practices are of concern or explain what changes you're thinking about. Gauge the responses, but don't ask for a voting commitment unless you're soliciting pursuant to proxy materials filed with the SEC. And it is sometimes necessary to reach out to investors during the proxy season, especially if you're faced with a negative ISS recommendation. But be aware that proxy season is a very busy time for institutional investors. And it's also important to time meetings after the proxy season to get shareholder feedback on particular aspects of a compensation program which might not be evident from a simple yes-no vote on the entire package. The company then has time to address concerns in the coming year, which in turn will give the company something concrete to report in its next CD&A, because you do have to disclose how the prior year vote was taken into account. Design presentation is taking a greater role as we see more and more glossy proxy statements with colorful graphs. This, of course, costs money, and each company must decide if design features truly add value. But perhaps some of these additional costs can be balanced against reduced printing costs as a result of the growing popularity of e-proxy. Proxy statements have gotten longer both as a result of disclosure requirements and as advocacy for compensation programs. As a result, proxy statement summaries have become very popular. In a hyperlinked table of contents, particularly with entries for CD&A subheadings, is an easy way to make the proxy statement more user-friendly. And with so much of proxy review being done online, companies are also paying attention to online versions of their proxy statements, for example, by improving the ease of navigation. Design elements do not always translate well in the EDGAR format, so some companies are also filing a PDF version of their proxy with the SEC in addition to the mandated EDGArized proxy, so that people will, through the SEC website, have a sharp version that you can see the design as it was intended. In these next two slides I've included from Coca-Cola's proxy statement just to show how graphic design can dramatically illustrate financial points. So moving on to the CD&A itself, recognize that it's become more than just required disclosure, which of course it is, but it's also effectively the selling piece for a favorable say-on-pay vote. An executive summary for the CD&A is not required, but it's helpful. It is the place where you can most efficiently present your case for executive compensation. For some investors, the summary will set the stage for the rest of the CD&A. For others, the summary might be all they're going to read. Be sure to express your goals clearly in the CD&A and highlight recent changes, especially if they're designed in response to shareholder feedback. Pay for performance has become a mantra, but don't just pay lip service to that obligatory phrase. Use the CD&A to pinpoint how performance impacts the various aspects of compensation. And think of ways to break up text with easy-to-understand visuals such as graphs and tables. There are, of course, many ways to begin the CD&A. This Goldman Sachs example starts with a key topic section, which to me is a hybrid between an executive summary and a hyperlinked CD&A specific table of contents. MasterCard includes charts with recognizable symbols as part of its executive summary. And I'm going to show you the Neighbors proxy because it illustrates how the response to say-on-pay vote is important to include and present, and they did it even before they came to the compensation highlight section of their executive summary. There are also a number of ways in which compensation disclosure can be supplemented with additional soliciting materials. As a reminder, all these additional materials have to be filed with the SEC before they're used. This slide is an excerpt from a Glossy compensation document separate from the proxy statement that ExxonMobil distributes as part of its proxy materials. ExxonMobil also updated its benchmarking material in another document once 2014 data became available, and it put on a 1-hour webinar on compensation complete with a 30-page slide deck that it filed with the SEC. I've just included one of the slides here. And it is by no means necessary to prepare additional material of the types ExxonMobil has developed, but I do think it's useful to review the variety of its supplemental presentations to get a sense of what's out there. If a proxy firm identifies problematic pay practices, such as a disconnect between pay for performance, or a specific practice such as a tax gross-up which it finds objectionable, it'll recommend that its clients vote against executive compensation and, in some cases, directors. Many companies feel compelled to file additional soliciting material with the SEC specifically to counter an ISS negative recommendation. These materials are not likely to change an ISS recommendation, and they may not change the ultimate voting outcome, but they can be useful. For example, there's something tangible to give to a supportive analyst at an investor who can then pass it along to the person in its firm in charge of proxy voting, hopefully with a cover note suggesting a vote in favor of pay. It also has the added benefit of showing management that you are doing something. And these next few slides are examples of additional materials expressly responding to negative ISS recommendations. And when you get the slides after the program, you can look at those in more detail. So before I finish, I want to talk a little bit about the threat of litigation, which is another reason why companies are concerned about failed say-on-pay votes. Over the years, there have been several waves of compensation litigation, including suits to enjoin shareholder meetings, which can be very disruptive, as well as suits seeking damages and really attorney fees. In a recent case, the Templeton that I've noted, outside director compensation was challenged, and the court treated those director awards as self-dealing decisions, holding that entire fairness review is the operative standard. And I'll just finish my remarks with something that's not truly a this season proxy matter, but one affecting the 2017 season, which for many companies is going to be the next time the frequency vote is needed to say when on pay. So nothing for this year, but do note your calendars for next year. And with that, I'm going to turn the mic back over to Mike.
Thanks, Laura. I'm going to spend the next 10 or 12 minutes talking about two recent SEC compensation-related rule proposals that were mandated by Dodd-Frank. One relates to compensation clawback, and the other relates to pay for performance. I'll get started with the clawback proposal. The SEC has proposed new Rule 10D-1, which would direct the national securities exchanges, such as the New York Stock Exchange and NASDAQ, to establish listing standards that prohibit the listing of any security of a company that does not adopt and implement a written policy requiring the recovery or clawback of certain incentive-based compensation. The rules were proposed on July 1st of this year, and the comment period ended on September 14th, about 5 weeks ago. Before I get into the substance of the proposal, let me say that I don't think that the clawback proposal will be in effect for the upcoming proxy season, because not only does the SEC have to adopt a final rule, the exchanges will then have to propose and adopt listing standards. The reason why this is important is that if a company finds itself in a clawback situation, it may have to include certain disclosures in its proxy statement that I will describe shortly. The application of the rules would turn largely on the definition of two terms, incentive-based compensation and financial reporting measure. Incentive-based compensation would be defined to mean any compensation that is granted, earned, or vested based wholly or in part on the attainment of any financial reporting measure. A financial reporting measure would be defined to mean a measure that is determined and presented in accordance with accounting principles used in preparing the company's financial statements. Any measure derived wholly or in part from such financial statements, including non-GAAP financial measures, and stock price and total shareholder return. Any recovery under a mandated clawback policy would be the amount of incentive compensation that is later shown to have been paid in error based on an accounting restatement that is necessary to correct an error. So in essence, it becomes the amount the person received versus the amount that they should have received. Where the compensation was directly tied to a number in the financial statements or to a non-GAAP financial measure, it may be fairly easy to calculate the difference. But there are two special situations: awards based on stock price or total shareholder return, and awards paid from a bonus pool. Because incentive-based compensation that is based on stock price or total shareholder return is not subject to mathematical recalculation directly from the information in an accounting restatement, companies would be permitted to determine the recoverable amount based on a reasonable estimate of the effect of the accounting restatement on stock price or total shareholder return. If a cash award is paid from a bonus pool, the size of the aggregate pool would be reduced based on applying the restated financial reporting measure. No recovery would be required in cases where the aggregate pool would have been sufficient to cover individual bonuses. However, where a reduced bonus pool is less than the aggregate amount of all individual bonuses received from it, the excess amount that a company would have to recover would be the executive officer's pro rata portion of the deficiency. There are just a few other highlights of the proposal that I want to mention. The clawback provisions must apply to any individual who served as an executive officer at any time during the performance period, whether or not the person is an executive officer at the time of the restatement. So companies will need to be thinking about how they structure their compensation programs to be able to recover compensation from former employees. Unlike the Sarbanes-Oxley clawback provisions, this clawback provision is no fault. So the provisions apply to any executive officer, whether or not the person engaged in misconduct or was responsible for the erroneous financial statements. A company would be required to recover any incentive-based compensation paid during the 3 fiscal years preceding the date on which the company is required to prepare the restatement to correct a material error. Clawback policies would be required to be filed as an exhibit to a Form 10-K. As I touched on earlier, a company must include disclosure in its proxy statement if it prepared an accounting restatement that required a clawback and it had an outstanding balance of unrecovered excess incentive-based compensation. The information to be disclosed includes the names of each person subject to a clawback and any amounts that have been outstanding for at least 180 days. Recoveries are based on pre-tax amounts, which could cause problems for recipients, such as if they had settled an equity award on a net share basis. Those recipients could wind up paying more back to the company than they actually received on settlement and having to work through the tax issues separately. A company would not have to seek recovery if the direct expense of recouping compensation would exceed the amount recoverable. A foreign company would not have to seek recovery if it obtains an opinion of home country counsel that recovery would violate a home country law adopted prior to July of this year. In connection with pool plan recoveries that I mentioned earlier, recovery from all covered executive officers would have to be pro rata. A company wouldn't be able to seek a different recovery from different executive officers. A company would be prohibited from indemnifying their executive officers for amounts recoverable pursuant to clawback policies or paying premiums on insurance policies protecting against such recoveries. These liabilities are liabilities of the person and not of the company. The proxy statement disclosures, if some are required to be provided, would have to be block tagged using XBRL, and summary compensation table amounts would be restated to reflect the impact of any clawbacks. Even though the rules are not yet effective, there are a couple of things companies should be thinking about now. Companies with existing clawbacks should be thinking about what changes will need to be made to those policies to comply with the rule when it finally gets adopted. Companies without existing clawback policies should be thinking about what aspects of their compensation will be subject to the recovery provisions and how they plan to implement the policy. In addition, these companies should be thinking about whether to implement a policy now, even though it might subsequently change, to address concerns of some large shareholders and proxy advisory firms. In addition, companies should also be thinking about how they will implement any policy under other laws, such as applicable state laws, particularly with respect to previously earned compensation or with regard to persons who are no longer employed by the issuer. This could require an analysis of the laws of each state where the executive officers or former executive officers are located, both at the time they earned a compensation and at the time that a company may be seeking to claw back some of that incentive-based compensation. And now I want to spend just a couple of minutes talking about the pay for performance proposal. The SEC has proposed adding new subsection V to item 402 of Regulation SK, requiring companies to disclose in a clear manner the relationship between executive compensation, actually paid, and the financial performance of the company. The rules were proposed on April 29th of this year, and the comment period ended on July 6th of this year. All companies would be subject to this requirement, except for foreign private issuers, registered investment companies, and emerging growth companies. There's two aspects to this proposal. The first is a chart that would appear in proxy statements. On the slide that's up right now is a form of what that chart would look like. And basically, you can see that there are multiple columns. There is the summary compensation column for the principal executive officer, and a column for the compensation actually paid to the principal executive officer. There's a column for the average summary compensation table total for the non-principal executive officer named executive officers, and then the actual compensation for those same average compensation actually paid to those same officers, a column for total shareholder return, and a column for peer group total shareholder return. When fully phased in, the chart would require 5 years worth of information. A couple of other things about this chart. If there is more than one principal executive officer during the year, all compensation for such persons would be aggregated for that year, in that line. And the other is the average. You could provide this average that's here. It's also possible that you could separate them out individually by the other named executive officers, so I don't think most people will probably be inclined to do that. There are two exceptions. So for the most part, all of this information is going to be the same as that's now prepared for either the summary compensation table for the named executive officers or for the performance graph by the company. But there are two exceptions to that, and both relate to in connection with determining the compensation actually paid. The first is that the aggregate change in actuarial present value of the accumulated benefit included in the summary compensation table would be deducted from the summary compensation total, and the actuarially determined service costs for services rendered during the year by the executive would be added in its place. And second, equity awards granted during the year would be deducted from the summary compensation total, and equity awards vested during the year would be added based on their fair market value on the date of vesting. In addition to the table, companies will also need to accompany the table with a clear description of the relationship between pay and performance in narrative or graphic form or a combination of the two. So, for example, a company could plot the various numbers on a chart showing total shareholder return, peer group total shareholder return, the compensation that was actually paid to the principal executive, and the average compensation actually paid to the non-principal executive, and work those numbers through on a chart, or it could describe this textually, or it could do both. The proposal has a fair amount of flexibility. As with the clawback rules, these proxy statement disclosures would have to be block tagged using XBRL. So whichever of these two rules gets implemented first will be the first time that companies have to data tag some of their disclosures in a proxy statement. The disclosures under this rule proposal would be phased in over a 3-year period. So the first year of including the information, the chart, and the other information would have 3 years worth of disclosure in year 1, 4 years worth of disclosure in year 2, and 5 years worth of disclosure in years 3 and thereafter. Finally, it is unclear when the SEC will adopt final rules and whether they will be effective for the upcoming proxy season. However, one thing that companies should be thinking about now is the relationship between this disclosure and other disclosure that is provided in the CDNA, particularly if it says that a company pays for performance. A question to be thinking about is, will the numbers that wind up getting disclosed in response to this requirement back up the disclosure that's included in the CDNA? And if not, companies should be thinking about how that might impact or change their CDNA disclosure. And with that, I will now turn the program over to Jen to get us started talking about the pay ratio disclosures.
Thanks, Mike. I'll be discussing the new pay ratio disclosure rule and also the proposed hedging policy disclosure rules, both of which were mandated by the Dodd-Frank Act. So first, the pay ratio disclosure rule. Dodd-Frank directed the SEC to require disclosure of the ratio of the median annual total compensation of all employees to the annual total compensation of the CEO of the company. The rule was first proposed in 2013, and the final rule, which was adopted in August, is substantially the same as the proposed rule. Companies subject to the rule will be required to provide disclosure for the first fiscal year beginning on or after January 1st of 2017. And disclosure must be included in any filing that requires executive compensation disclosure, so not only proxy statements, but also information statements, annual reports, and certain registration statements. Certain companies are exempt from the pay ratio disclosure, including those listed here. And in addition, there are transition periods that are applicable for newly public companies and for business combinations and acquisitions. Next slide, please. The new pay ratio disclosure rule is an item 402U of Regulation SK and provides that companies must disclose the following information: the median annual total compensation of all company employees, except for the CEO, the annual total compensation of the CEO, and the ratio of these two amounts. The disclosure can be presented as either a ratio, such as 50:1, or it can be presented as a narrative, such as the CEO's annual total compensation is 50 times the median of the annual total compensation of all company employees. And note here that the pay ratio is also required to be tagged using XBRL. Next slide, please. The new rule defines which employees are to be included when determining the median annual total compensation of all employees. An employee is defined as an individual employed by the company or any of its consolidated subsidiaries. This includes U.S. employees and non-U.S. employees. However, the final rule does permit two exceptions from the inclusion of non-U.S. employees, which I'll discuss in the next few slides. Employees also include full-time, part-time, seasonal, and temporary employees, and all officers other than the CEO. Employees do not include workers that are employed by and whose compensation is determined by an unaffiliated third party, such as independent contractors or leased workers. Next slide, please. As I mentioned, there are two exemptions from the inclusion of non-U.S. employees, the first of which is the data privacy exemption. Under this exemption, a company may exclude employees in jurisdictions with data privacy laws that make the company unable to comply with the pay ratio rule without violating those laws. But the company must exercise reasonable efforts to obtain or process the information about the employees, including, at a minimum, seeking or using an exemption and obtaining an opinion of counsel that states that the company cannot obtain or process the necessary information without violating the applicable privacy laws. The company must include the opinion as an exhibit to the filing containing the pay ratio disclosure. If a company uses an exemption, it must disclose all excluded jurisdictions and identify the specific data privacy law. It must exclude all non-U.S. employees in the jurisdiction and list the approximate number of employees there. And it must explain how complying with the rule violates such law and disclose its effort to seek or use an exemption. Next slide, please. The second exemption from the inclusion of non-U.S. employees is the de minimis exemption. Under this exemption, if the non-U.S. employees account for 5% or less of total employees, the company may exclude all, but not less than all, of such non-U.S. employees. Or, if the non-U.S. employees exceed 5% of total employees, the company may exclude up to 5% of total non-U.S. employees. Under the second part, the company must exclude all non-U.S. employees in any one jurisdiction, and therefore it can't exclude employees from a foreign jurisdiction where more than 5% of its total employees are located. A company using this exemption must disclose the jurisdictions involved, the approximate number of employees excluded there, the total number of U.S. and non-U.S. employees irrespective of the exemption used, and the total number of all employees used for this exemption. In addition, it's important to note that any employees excluded pursuant to the privacy exemption will count toward the 5% de minimis limit. So there is interplay between the two non-U.S. employee exemptions. Next slide, please. So moving on from the definition of employee, a company must identify its median employee. And the company can use a method that is based on its own facts and circumstances. So the median employee may be identified using any consistently used compensation measure, such as compensation amounts reported on its tax or payroll methods. A company may identify its median employee based on total comp of the full employee population, or can use a statistical sample or any other reasonable method. And the SEC's adopting release provides guidance on this. The median employee should be an actual employee, but companies are not required to and should not identify the median employee by name or other identifiable information. While it might be instructive to generally identify the median employee's position to place the disclosure in context, the company should do so or should not do so if providing that information could identify the specific individual. The company may choose any date during the last 3 months of the fiscal year for the purpose of identifying the median employee. And this employee should be identified once every 3 years unless the company reasonably believes that a change in employee population or compensation would result in a significant change to the pay ratio. If the company uses a previously identified median employee, it must disclose that there have been no such changes. Next slide, please. After identifying the median employee, the company must calculate such employee's annual total compensation in the same way it calculates the CEO's annual total compensation for the purposes of the summary compensation table. Now, this is true even if the company identifies the median employee with a compensation measure, such as amounts reported in its payroll methods. The pay ratio rule allows companies to use reasonable estimates to calculate total compensation for employees and in the methodology for identifying the median employee. The pay ratio rule also allows for certain adjustments to compensation in identifying the median employee and calculating compensation. I've listed a few of these adjustments here. One to point out is a company may use a cost of living adjustment for employees that do not live in the jurisdiction where the CEO resides. And finally, if a company has multiple CEOs in the last fiscal year, it can choose between either combining the total compensation provided to each CEO or annualizing the compensation for the CEO serving in that position on the median employee identification date. Next slide, please. In addition to the specific disclosure elements I've mentioned, the company must briefly describe in non-technical terms the methodology used to identify the median employee and any material assumptions, adjustments, or estimates used. Companies are permitted but are not required to include supplemental information and additional ratios that are clearly identified but that are not misleading and are not presented with greater prominence than the required pay ratio. Next slide, please. Companies will generally be required to report the pay ratio disclosure for their first fiscal year beginning on or after January 1st of 2017. As I mentioned earlier, certain companies are exempt from the rules, but such companies will need to comply with the rule for the first fiscal year in which they no longer hold that exempt status, but not before January 1st, 2017. For an IPO, disclosure will be required for the first fiscal year on or after January 1, 2017, but is not required in the IPO prospectus. And for M&A, employees that are part of the acquired company may be omitted from the identification of the median employee for the fiscal year in which the business combination became effective. Although employees may be omitted, the company must disclose the approximate number of employees that are omitted. Next slide, please. A few final points on the pay ratio disclosure rule. First, the disclosures will be considered filed instead of furnished, so therefore they will be subject to certifications and subject to the securities law liabilities. It's also worth mentioning here that 2 of the SEC's commissioners dissented from adoption of the final rule, which might help encourage a legal challenge against the rule, but companies should certainly assume that they will need to comply in 2018 and should begin preparations for the pay ratio rule, since there's a lot of work that goes into developing the disclosure. And we've listed here a few things to consider as you begin preparations. Next slide, please. Now I'll briefly go through a few slides on the hedging policy disclosure rule, which was proposed on February 9th of this year, but is not yet final. Dodd-Frank directed the SEC to issue rules that require companies to disclose whether they permit employees and directors to hedge the company's securities. The rule would be applicable to all companies that are subject to federal proxy rules, including those listed here. Next slide, please. So this slide simply restates the proposed new rule. A few things to note here. The disclosure would be required in any proxy statement or information statement with respect to the election of directors. The disclosure covers all employees, not just officers, and all directors of the company. And the disclosure covers any transactions that would establish downside price protection with respect to holding the company's equity securities. So this is a broad interpretation of hedging. It includes more than just the purchase of a forward contract or a similar instrument. Next slide, please. As I just mentioned, the proposed rules include some expansions of the type of transactions covered, but do not require companies to prohibit hedging or to adopt any specific practices or policies regarding hedging. Instead, the SEC release explained that the rules are aimed at providing transparency to shareholders for transactions that mitigate or avoid the incentive alignment associated with equity ownership by company employees or directors. Next slide, please. So many companies already discuss hedging policies in their CD&A, but the proposed rules extend beyond the current Item 402 disclosure. The rules apply to all employees and directors instead of just NEOs, and the rules apply to all companies subject to the proxy rules, including emerging growth companies and smaller reporting companies, which currently do not need to provide a CD&A. And remember that this is only a proposed rule, but it's certainly something to watch out for in the near future. So at this point, companies should be reviewing their hedging policies, if they have one, and identify any necessary revisions. And now I'd like to turn the presentation over to Harry. Harry?
Thank you, Jen. So let's take a look at shareholder proposal activity in 2015. Of course, the big story this year was Proxy Access, and I'll talk about that in a moment. The surge in Proxy Access proposals fueled an overall increase in shareholder proposal activity. Over 1,000 shareholder proposals were submitted to public companies this season alone. And as a result of the overall success of the Proxy Access proposals, more shareholder proposals received majority support from shareholders in 2015. For example, 11% of shareholder proposals put to a vote by Fortune 250 companies received majority support. This is the highest percentage since 2010 and up significantly from last year when only 4% of proposals received majority support. Once again, social and environmental policy proposals were the most frequently submitted, focusing on issues like the environment and political activities. And while these types of proposals are popular with shareholder activists, they have not received much support from shareholders overall. Aside from Proxy Access, there were fewer corporate governance proposals submitted this season, and this may be due to the fact that more public companies have either instituted some of these proposals, such as eliminating staggered boards of directors or adopting a majority vote policy for the election of directors, or in some cases splitting the role of the CEO and chairman. Another factor may be the rise in shareholder engagement, with management working directly with institutional shareholders to address corporate governance concerns outside of the shareholder proposal framework. Shareholder activism continues to be robust in 2015, although more companies were willing to negotiate settlements with activist shareholders and avoid proxy fights this year than in the past. And there continues to be an increase in the amount and quality of contact between companies and their shareholders. Next slide, please. So before turning to the shareholder proposal process, I wanted to mention an interesting paper that was recently put out by SEC Commissioner Daniel Gallagher and his counsel John Cook. In it, they argue that oversight for shareholder proposals should be returned to the states, so that a state where a company is incorporated would have control over the shareholder proposal process instead of the SEC. The paper goes into some detail regarding the SEC's recent difficulties in administering the proposal process, and essentially argues that states would be better suited to take on this responsibility. It's going to be interesting to see whether this proposal develops any momentum. For now, though, the shareholder proposal process is mostly managed by the SEC under Rule 14a-8. And I say mostly because we have seen instances where companies and activist shareholders are willing to litigate the process in court. So briefly, I'll just describe the process as it is today. Let's say you've received a shareholder proposal. What do you do? Naturally, you'll want to read it first. You'll want to see who the proponent is and what the proposal is seeking. You may have some initial thoughts on how you want to handle the proposal. But before you do anything else, make sure that the proposal is reviewed for compliance with the technical requirements of Rule 14a-8, because you have only 14 days to exclude the proposal for technical deficiencies. If you rely on outside counsel for review, be sure to send the proposal to them immediately. The technical reasons for excluding proposals involve a few items, and you'll want to confirm compliance with the following. First of all, that you can verify ownership. Has the shareholder provided proof of ownership of at least $2,000 worth of shares for the one-year period? If the shares are held in street name, the shareholder is required to provide a written statement from its broker as record holder with respect to ownership. And did the shareholder state that it will continue to hold the shares through the meeting date? The length of the proposal is an issue. It may not exceed 500 words. Was the proposal submitted timely? Generally, the proposal must be received at least 120 days before the anniversary date of the last proxy made available to stockholders. And there are some other technical requirements that you'll want to confirm. If you don't find any technical deficiencies and you still would like to exclude the proposal, you'll need to prepare a letter specifically identifying the substantive reasons for excluding it and seek no action through the SEC. And while you're, from the very outset, you should consider whether the proposal's compliance with substantive matters is proper. So next slide, please. There's the process for evaluating possible grounds for exclusion include, does the proposal relate to the ordinary business of the company? The SEC recognizes that day-to-day business of a company shouldn't be subject to shareholder oversight. Is the proposal relevant to the company's business? Now here the SEC gives the shareholder proponents a lot of leeway, particularly with respect to proposals related to ethical issues or social policies. Has the proposal already been substantially implemented by the company? Does the company have the power or authority to implement the proposal? And does the shareholder proposal violate the proxy rules? Is it materially false or contain misleading statements? Is it overly vague? Lastly, does the proposal conflict with a management-sponsored proposal? And I put an asterisk beside this one because it's not currently available as grounds for excluding a shareholder proposal, and I'll talk a little bit more about that. There are a few other grounds for excluding shareholder proposals, not all of which are listed here. So let's move on to the next step, which is preparation of the NoAction letter. And next slide, please. At this point, let's say you've reached out to the shareholder proponent and the conversations have not been productive. Whatever the case, you'll need to determine quickly whether you want to pursue NoAction relief. And here are some things to consider. What are the chances that the proposal will pass if put to a vote? If the proposal is near certain to be defeated, there may be little downside to including it in your proxy statement. Has the proposal been successfully challenged in the past, and do those circumstances apply to your particular situation? Are there any other clear grounds for excluding the proposal? Keep in mind that time is an issue here. The clock is ticking. NoAction letters take time to prepare, and they must be submitted at least 80 days before you file the definitive proxy statement. So, and don't expect to obtain a waiver if you had time to prepare the letter before the 80-day deadline. Next slide, please. Whether or not you are trying to exclude the proposal, you'll need to be thinking through your opposition statement. This is the company's opportunity to make arguments why it believes shareholders should vote against the proposal. And when crafting the opposition statement, you'll need to consider what issues are important to the proxy advisors and your large institutional investors. So you'll want to familiarize yourself with proxy advisor voting policy because they often outline circumstances where proxy advisors won't support the shareholder proposal. Similarly, understand what issues are important to your large shareholders and, to the extent appropriate, address them in your opposition statement as well. Next slide, please. Well, let's take a closer look at Proxy Access because this proposal alone accounted for over 10% of all shareholder proposals submitted this season. Just a brief background on Proxy Access. What is it? Proxy Access is a mechanism whereby a shareholder or group of shareholders can include their own candidate for election to the company's board of directors and include it in the company's proxy materials at the company's expense. Now, the SEC had adopted a uniform proxy access rule back in 2010. That rule provided that a shareholder or a group of shareholders who owned at least 3% of the company's voting stock could nominate a candidate for director to be included in the company's proxy materials. No more than 25% of the board would consist of shareholder-nominated directors. That rule, as many of you know, was subsequently challenged in court and vacated by the U.S. Court of Appeals in 2011. So rather than rework the proxy access rule, the SEC instead amended its shareholder proposal rules to essentially open the door for shareholders to submit their own proxy access proposals. And over the past 3 years or so, a number of proposals were submitted. it became clear that proposals calling for a 3% ownership, 3-year holding period requirement received the greatest amount of support. So about a year ago, the New York City Comptroller, next slide please, which manages a number of New York City pension funds, began sending proxy access shareholder proposals out to a number of large public companies. In total, the Comptroller sent out 75 proposals and targeted companies based on certain priority issues, which were climate change, board diversity, and excessive CEO pay. For example, 33 companies in the oil and gas industry received the Comptroller's proposal this season. Meanwhile, it appeared as though Whole Foods had found a way to exclude the proxy access proposal. It had received a proposal from another shareholder earlier and sought no action from the SEC on the basis that the shareholder proposal conflicted with a management proposal that had much more restrictive terms, including a 9% ownership requirement and a 5-year holding period. The SEC initially issued a letter granting no action relief and concurring that Whole Foods could exclude the proposal on the basis that it directly conflicted with the management proposal. And following that, a number of companies who received the Comptroller proxy access proposal submitted letters requesting no action relief on that basis. And then suddenly, the SEC, in effect, took this option off the table. SEC Chair Mary Jo White directed the SEC staff to initiate a review of Rule 14-8I9, which was the basis for excluding the Whole Foods shareholder proxy access proposal. And at least for now, companies are not able to exclude proxy access proposals or any shareholder proposal on the basis that they directly conflict with another competing proposal. Next slide, please. Here are a number of considerations and strategies that companies who received the proxy access shareholder proposal considered in responding. Most companies decided to simply oppose the proposal and included an opposition statement laying out their arguments why proxy access was not in the best interest of the company. Other companies opposed the proposal but also indicated they were open to considering adopting proxy access in the future after discussing with their shareholders. Some companies put both the shareholder proposal and a competing management-supported proxy access proposal on the ballot, and then others either remained neutral or actually supported the shareholder proposal. Next slide. Needless to say, there were a lot of close votes on proxy access. Of the 84 proposals that came to a vote, 50 have passed. The average vote in favor of proxy access was 55%. It got strong support from particularly pension funds. Interestingly, Fidelity would not support the proposal, and Vanguard said that it would assess on a case-by-case basis, but suggested that it would support a 5% ownership requirement. If you look back at the results of these proxy access votes, the key factor appears to be the makeup of the company's shareholder base. So if you have a high retail investor, you may have better odds. If your shareholders are managed, larger shareholders managed by Fidelity and Vanguard, your odds may be better. Next slide, please. Here are some key terms that companies are considering, companies that have either lost the vote or are considering preemptively adopting proxy access. Some of the terms are ownership, holding period, limitations on aggregating the number of shareholders who can form a group and nominate a shareholder, some qualifications on the nature of ownership, including requiring a net long position in stock. Next slide, please. Here are some other considerations as well in terms of crafting proxy access bylaws. In any event, the proxy access landscape continues to shift and evolve and will no doubt be a hot topic in the upcoming proxy season. The remaining few slides, next slide please, just a quick summary of some of the other proposals that came through in this proxy season. I will say the general statement that there was not a lot of change with corporate governance proposals. There was a slight decline in support and number of proposals issued. Next slide, please. Action by written consent proposals increased in 2015, but only 2 proposals received majority vote. Next slide, please. The increase in compensation proposals, there was an increase in 2015 with the focus on limitation of single trigger acceleration of equity awards. Next slide. Not a lot of change in political spending and lobbying proposals in 2015. They were reduced somewhat possibly because we're in an off-election year. And lastly, next slide, environmental issues, shareholder proposals were essentially unchanged. So with that, I'll turn it back to Mike Hermsen.
Thanks, Harry. Let me wind up with a few brief thoughts on a couple of related matters. D&O questionnaires. There is nothing new from the NYSE, the NASDAQ, or the SEC that should cause changes in the questionnaires for this upcoming year. But in connection with the PCAOB's new related party requirements that apply to 2015 audits, we understand that some accounting firms are asking clients to have questionnaires elicit a list of all members of an insider's immediate family. A question to consider is whether this should be part of the D&O questionnaire or a separate questionnaire. Companies should discuss this with their auditors to make sure that the auditors are comfortable with how the company is gathering the necessary information. Universal proxy cards. These will not be in place this year, but this is something we should all continue to monitor as there is increasing interest in moving to a single proxy card in situations where there is the potential for a proxy contest, or at least where there are more people up for nomination than what there are available seats. Online virtual annual meetings. We're seeing more questions on this as many companies are interested in exploring ways that might either generate more interest in people in attending the meeting or result in reduced costs of holding the meeting. We still aren't seeing a lot of companies doing this, but it is something worth continuing to monitor, and we think this will continue to be an area with some movement in the future. Conflict minerals update. We're pretty much where we were a year ago. The courts have held that companies can't be required to disclose that their products are conflict-free or similar characterizations. However, the SEC still hasn't made public whether they've decided to challenge this decision. In the meantime, we are hoping that the SEC may issue some clarifications of the requirements in light of the fact that the 2-year phase-in period has now ended. If you follow this area, a couple of years ago, Keith Higgins, the director of the Division of Corporation Finance, came out with a position of what companies were supposed to do during this 2-year phase-in. Right now, the phase-in has ended. The positions are still in place, but I think people just want to make sure how the SEC is going to apply this now going forward. And the final thing I wanted to touch on was a resource extraction update. The SEC has been challenged in court on the fact, maybe a little bit more background. The SEC adopted resource extraction rules as it was required to do. Those rules were overturned by the court. The SEC has now been challenged in court on the fact that there are not rules currently in place. In response to that current litigation, the SEC has informed the court that it will repropose its resource extraction rules in the near future, and it has set a schedule hoping to have final rules adopted by next summer. The SEC recognizes that this might be an aggressive schedule, but it is something to continue to monitor, particularly if the rules would apply to you and the disclosures that you have to provide. And with that, I want to thank you very much, Harry, Jennifer, and Laura, for also participating in today's program. And on behalf of Mayor Brown, I want to thank you, everyone else, for participating in today's webinar. We really appreciate it. As Laura alluded to in her remarks, materials from today's webinar will be emailed to all participants within the next 24 hours. CLE certificates will be distributed to eligible attendees within 30 days. And with that, I will now turn the program back to the operator.
Thank you, ladies and gentlemen. This concludes today's conference. Thank you for participating. You may now disconnect.